For several years now, humans have devised a medium of interaction and financial exchange among one another. We can trace the history of exchange to barter trading before physical medium of payment. However, that was short-lived as the no-cash policy was invented as authorities began to question the future of money and monetary assets. Before long, the idea of digital money came into view. What is the best way to keep your money than have it digital, right? The bombshell is that nothing in this world exists without its own fair share of challenges. The same goes for our digital medium of exchange. In this video, you should expect to have a fuller knowledge of cryptocurrency, and the current challenges facing the market are specifically picked out for you. We love you, and a little reciprocity will be appreciated. You can show us some love by liking this video and subscribing to my channel. Now, cryptocurrency, or would you rather say crypto, is a digital currency specifically designed to serve as a means of exchange. It works through a computer network that not reliant on any central authority to ensure its effectiveness or maintenance. You know, authorities like the Central Bank of Nigeria, mortgage banks, or even your government. This is how cryptocurrency works. Individual records are stored in a digital ledger. A digital ledger, in case you are wondering, is a computerized database that uses strong cryptography to secure transaction records, creation of additional coins, and verification of transfer of coin ownership. Although despite their name, cryptocurrency are not considered to be currencies in the traditional sense because they do not exist in physical form, unlike paper money. When a new cryptocurrency is minted before insurance are issued by a single user, it is considered centralized, but when it is implemented with centralized control, each cryptocurrency works through a distributed ledger technology, usually a blockchain. The first decentralized cryptocurrency was Bitcoin, which is often referred as the father of all cryptocurrencies because of its length of existence. It has endured time as it was first released in 2009 by a supposed pseudonymous developer, Satoshi Nakamoto. It uses a cryptographic hash function in its proof-of-work scheme. However, as of March 2022, there were over 9,000 other cryptocurrencies in the crypto market, of which over 70 has a market centralization exceeding $1 billion. From the time of Bitcoin, which was indeed a success, cryptocurrency have been long paraded as the future of finance until 2020, when traditionally conservative and risk-averse institutions became proactive investors in this alternative asset class. Over the last few years, the two most popular cryptocurrencies, Bitcoin (BTC) and Ethereum or Ether (ETH), has drawn a lot of interest from all spheres of life and has experienced a lot of significant price volatility. Today, anyone who claims to not have heard the term cryptocurrency would be considered illiterate, as even authorities jumped on the bandwagon of crypto trading until 2019. Just before blockchain could have enjoyed public acceptance, the revolution came to an abrupt halt, which the Gartner Group described as blockchain fatigue. Although people thought this would only be a temporal phase in the history of cryptocurrency and crypto market, but it has overstayed its welcome. It has been a major concern in the minds of crypto traders, especially as many go from loss to more losses. Perhaps you're considering investing into crypto, or you're just going to join the bandwagon of cryptocurrency. It is important that you also are aware of the current challenges facing the cryptocurrency market. Some of the challenges facing cryptocurrency market are diversity, valuation difficulties, regulatory and legal dilemmas, illiquidity in trading costs, custody, clearing and settlement problems, boom phase for blockchain, bad imagery, the stakes are high, and transparency. Diversity. Cryptocurrencies have proven to be qualitatively diverse and not interchangeable. The long array of cryptocurrency differs across multiple dimensions, especially in relation to security, programmability, and governance characteristics. Simply say, there is no cheap to deliver cryptocurrency. For instance, BTC is a relatively simple construct. It was designed to receive, send, and keep value in a virtual and cryptographic format, with its functions replicating that of money. However, ETH goes a little bit further by adding more complex and self-executing capabilities that can be used to digitally replicate difficult financial instruments, performance contracts, and transactions. It becomes even more complex with the specifics associated with the issuance and governance of crypto. Valuation difficulties. For crypto, there is no consensus valuation approach or any commonly accepted metrics, and reported pricing may differ substantively across venues, all of which are necessary to manage the risk of any financial instrument. The valuation approach of cryptocurrency is complex and occasionally inconsistent. Some analysts tackle this challenge from a functional point of view by treating cryptocurrency as currency in circulation or flat money like USD or Euro. However, this approach builds a distorted assumption that suitably glosses over the fundamental legal difference between cryptocurrency and traditional financial instruments like cash. Regulatory and legal dilemmas. Unlike other financial instruments, cryptocurrencies are not regulated by any regulatory body. They are not a regulated product, and so they do not benefit from the standard legal protection other financial instruments enjoy. This leads to legal risks and adds uncertainty, which can in turn meaningfully affect both investability and risk management for these digital assets. As of now, there is still no internationally agreed means on how to best regulate cryptocurrencies, especially with respect to policing product development and trading. This is because the stance of government has been inconsistent. Illiquidity and trading cost. The cryptocurrency market is less liquid and more expensive than traditional market. This is because the supply of many cryptocurrencies is controlled with new units released according to a preset timetable. Hence, it should be a surprise to see that the high volatility of cryptocurrency prices is illiquidity driven. It is likely that cryptocurrency markets will continue to struggle with limited liquidity and high volatility, which makes effective price discovery an ongoing challenge. Gapping, on the other hand, continues to be a problem. Custody, clearing, and settlement problems. Apart from further regulatory clarity, oftentimes, institutional interests in cryptocurrencies depend on continued developments in providing prime brokerage and institutional-grade custody solutions. Today, however, specialized financial institutions and fintechs offer highly bespoke solutions that range from simple digital wallets to a complex array of functionalities which is intended to satisfy institutional investors. Institutional custodial solutions for cryptocurrencies are complicated, though part of the complexity is caused by individual, public, and private encryption that systems use to track and verify transactions cryptographically. Boom phase for blockchain. While cryptocurrency was facing the issue of surviving and being accepted by the masses, blockchain has already surpassed it. The masses have accepted it with open arms, and big names of global trade specialists are now looking at the area of blockchain. The concern, however, is that once the blockchain technology takes off without crypto, it will be the end of it. PR problem. Even though crypto has gone through the boom phase, it still has the PR problem. Many people are quite skeptical when it comes to crypto, and the terms associated are enough to conjure up images of bad advertisements, get-rich-quick scheme, and criminals alike. For many people, cryptocurrency is only a new technology for age-old scams. The stakes are high. The results of no action from major industries and authorities, industrial giants, businesses, and government authorities has been so altering since these years of crypto trading and even now. There is no denying the fact that the stakes are high for cryptocurrency and the future is yet unpredictable. Transparency. It is a well-established fact that many ICOs end up unsuccessful, while some of them are even fraudulent. Furthermore, many expensive crypto projects often make a case for themselves and claim they are decentralized when in reality 80% of the top 50 coins are held by the top 20 wallets. As a class of assets, cryptocurrencies have slowly emerged over the past decade and have won over the hearts of many institutional investors. The rise in demand, however, requires a more professional assessment of the underlying sources of risks and opportunities. The calls for better risk management are a part of the maturation of the market, which may include, for instance, replacing self-regulation and automated governance with effective supervisory and regulatory structures. We have come to the end of this video. If it has been helpful to you, take a quick step to like this video and subscribe to my channel. Don't forget to check out my other videos where many of your questions are lucidly answered. Your comments will also go a long way to review our work and help us serve you better. Till another time, bye!